Welcome back, folks. I'm going to do a quick little review here, and I'll squeeze in another approach to using some of the PD arrays I've already taught and how we can kind of like build a model around it. That'll come at the end of the video here. For now, let's take a quick look at the higher time frame on the US dollar index. The last time we talked, I mentioned that we would be looking for a potential run up into here. This was the buy side liquidity pool. I mentioned we were driving up into that. We've seen that, and then at a later time we might see this actually happen. It did. We stayed bullish. We haven't been looking for lower prices on dollar. There's a small little volume imbalance right in there. Watch that going into next week, and then obviously the buy side resides here. So a really strong run below these relative equal lows. Sell side liquidity taken, fair value gap traded up, and continuously moved into the buy side. We had here, here, and here. Longer term, we have this. So dollar showing its underlying strength, and it's still going to put intermediate term, long term pressure on euro dollar wanting to go lower and pound dollar wanting to go lower. Speaking of euro, here is the daily chart for euro dollar, and I mentioned the inversion fair value gap. We trade up into that. Look at the bodies again, respecting consequent encroachment, which is the midpoint of any gap. Market broke it lower, taking the sell side out here. And then we moved aggressively in this direction towards the sell side throughout the entirety of this week. It would have been nice to see this trade up into this small little gap here. I was kind of looking for that today. But the failure to get up there is, it's indicative of heaviness. Heaviness meaning that the market's likely to go lower and, again, attack that sell side. So with higher dollar prices, we're going to stick with the idea of looking for lower prices for fiber. And fiber is just a nickname for euro dollar. Okay, cable or pound dollar. You can see we have a inversion fair value gap here. The market's been breaking lower. Next draw on liquidity still remains at the sell side liquidity here. This one, we trade up into this small little fair value gap there. You can look at your lower time frames. We trade up into that. This is institutional order flow entry drill, where it goes into a partial, but less than half of a fair value gap there, and then sells off. So we'll be looking for near term. We have sell side resting below here, and we have the sell side below here. So we're maintaining a bearish stance still for British pound. So if you guys appreciate or like these longer term, bias based ideas for Forex, I'm not going to be drawing your attention to the smaller time frames because I don't think that it is something that we should be doing right now. It's something for you to do on your own analysis, but from the higher time frame, I'm just lending my experience to give you the bias, and you can see pretty much it's been delivering like gangbusters. So if you like that kind of stuff and you want me to continue, just give this video a thumbs up. E-mini S&P futures contract, September delivery, daily chart. Okay, and we just fell short yesterday going into this discount fair value gap. So it just got really, really close, but not quite getting into it. We have this buy side imbalance, sell side inefficiency between this candle's low and this candle's high. That's the blue lines here. That's denoting that buy side imbalance, sell side inefficiency. And this red line is consequent encroachment, or midpoint between this candle's low, this candle's high. So all this big movement up here, it's buy side imbalance, sell side inefficiency. So it needs to see what lower price is delivered. We've seen that happen here. And this price movement here is, in my opinion, what we're having to deal with on the lower time frame. So if you watched how we traded on Wednesday, Thursday, and Friday of this week for index futures, unless you were ultra short term, like 1 minute scalping, 5 minute scalping, you probably experience a lot of difficulty in terms of navigating, the ebb and flow of intraday price action. So whenever we have these kind of like bookends. Think of it like that. Okay, we have strong opinionated reasons that we can make the case for higher prices and for lower prices. And when we have that, everything makes trading with a great deal of precision that would otherwise be apparent in all time frames. It kind of reduces it down to a very infrequent, well, at least you may observe that it will be infrequent. We've seen that on Wednesday, Thursday, and Friday. Now, the latter part of Wednesday, not the first part of Wednesday, but the afternoon of Wednesday, Thursday, and then Friday's trading. We're seeing all that in here. So it's going to have to move outside of this range definitively for me. So in other words, it's got to either trade above the buy side and balance sell side inefficiencies high, or it's got to trade below the buy side and balance sell side inefficiencies low. While we're in here, I will not be interested in taking any trades for E-mini S&P. This area here is a fair value gap from this candle's low, this candle's high. The shaded area is denoting that. On the hourly chart, you can see how we had a fair value gap here, institutional order flow entry drill, which is a partial entry, but just falling short of half the gap. Breaks down, one more time, does the same thing here. Look at all this range bound trading right in there. See that? And then we break lower, small little range, break lower, small little range, and displacement to the downside, trading to the low of the inefficiency or the buy side and balance sell side inefficiency on the daily chart. Remember, the blue lines denote that big singular up close candle. And in the red level is the midpoint of that. And that shaded area is the fair value gap on the daily chart. We trade up to consequent encroachment here, roll over, and just fell short of trading into that inefficiency on the daily chart and sweeping below this low. So it fell just short of reaching into that. And then we had this gnarly Thursday and Friday trading range for E-mini S&P, returning back to consequent encroachment. 15-minute time frame, again, you can see how we had Friday's trading, Thursday's trading in the afternoon, retracing back up into consequent encroachment. So a really nice sell-off here in the morning, which was really easy to see that. All of this price action here, this right here, you have to be extremely nimble and know exactly what you're looking for. If you can get it, take it and stop. Otherwise, you can get chopped up in here, overtrade, or do a lot of things that would otherwise undermine your growth or create drawdown for your account. So these are problematic areas. Until we leave this range, I'm not interested in touching it. So if we stay within this, when we open on Sunday and trade into it on Monday, my hands will be away from all asset classes because my only interest right now in trading is the index futures, S&P and NASDAQ. NASDAQ daily chart, similar vein. We have the buy side and balance sell side inefficiency defined by this candle's high, this candle's low. Midpoint is consequent encroachment. And price will have to leave this buy side and balance sell side inefficiency either higher or lower before I'm interested in trading, because we had this run up. I like the idea of potentially trading down to 15,126 and a half. I mean, that's what I'm interested in seeing. I want to see that happen because we've seen it happen for ES. The run up, we've seen a partial decline, which we'll look at that, and I called that level real time before it actually is delivered on Thursday, right on Twitter. Or we could rally higher and come back out of this buy side and balance sell side efficiency and then resume going higher and reach for the buy side here and completely close in this inefficiency over here in the form of a SIBI. So because the analysis is conflicted, meaning that we could range bound in here for a little while and still deliver to that 15,126 and a half. That's what I'm kind of expecting to happen, but I'm not excited about taking any trades in here until we definitively leave this buy side and balance sell side efficiency. The reason why is because even though I like the idea of going short, I could be wrong, and it may be just accumulating in here to go higher. because this stock market, is absolutely rigged. Okay, I mean more than it really is. Okay, any other time, they're propping this market up for political reasons. There's no reason for, and there's no justification for the shares being at the levels they are for stocks right now. It's not warranted at all. So because we're seeing conflicted both sides of the narrative on the higher time frame, that forces your hand to be an intraday scalper. Short-term trading, swing trading, you have to be very, very precise. You get really one entry and that's it. So on a very small 1 minute time frame, you'll have a little bit more opportunities to navigate, but you have to have experience and be nimble. So I'm just showing you my cards. I'm not terribly excited about going into next week until we leave this buy side and balance, sell side inefficiency. On the hourly chart, you can see we ran buy side here into a bearish order block. We broke down, bearish order block here, displacement to the downside, swept the sell side here, entered the buy side and balance, sell side inefficiency, rolled over after institutional order flow entry drill here, which is just a partial entry into this SIBI. I'll try to keep the charts clean so that way I would have less to talk about to get through this chart discussion quicker for you this evening. We rolled through, went through half of the daily buy side and balance, sell side inefficiency, which is the consequent encroachment level, that blue line, which is just midpoint between the lower level and the higher level of the daily buy side and balance, sell side inefficiency. That one singular big green candle on the daily chart, that's the reference points here for it on the hourly chart. So we rolled over, and I gave on Twitter on Thursday, I said to have 15,185.25 and 15,175 noted on your chart. And we went down. The bodies respected both of those levels. We wicked through both of them. 15,175 is this candle here. So there's a buy side and balance, sell side inefficiency between this candle's low, this candle's high, with this one big candle. So that's where that 15,175 level came from. The 15,185 and a quarter level, which is here, is the daily buy side and balance, sell side inefficiency 25% quadrant. Okay, so in other words, if you take this level here and this level here and divide it in equal parts, 4 equal parts, half is here, so halfway between this level and here is this. So it's the lower quadrant, 25% level of here. That's not quarters theory, by the way. Right away, I know some of you think, oh, he's teaching quarters theory. It's not quarters theory. I'm looking at an inefficiency and I'm grading that, just like I teach how to grade a price swing in my core content. So these are all algorithmic signatures that price will respect and adhere to. So it's important to know what they are and how to apply it to your charts and then anticipate these types of responses. The market rallies off of that on Thursday, comes back in and retrades back to the consequent encroachment midpoint, and then sends us back up to the high end of the daily buy side and balance, sell side efficiency high. On the 15-minute time frame, you can see how, again, on Friday and on Thursday, just a really gnarly trading range. I mean, you can grow very frustrated trying to trade this if you're trying to anticipate a follow through either higher or lower. You have to be very, very nimble and look at the lower time frames. Pick your shots. If you get a winner, stop for the day or the session and be done, and try not to force your hand too much. All right, so here's the 1 minute candlestick chart for the NASDAQ, and I'm going to teach you something that employs my inversion fair value gap. Now, before I get into this, there's a couple points I want to make, because there are a couple romper room mentors out there that will tell you that a fair value gap is something that is simply a support or resistance level in a lower time frame. That's not true. That's not what it is. It's an actual inefficiency. This little area in here where one single candle pass up to the upside, that's a buy side and balance, sell side inefficiency. So it's not had any overlapping with any other candles after it formed on the downside. So it's lacking what? Sell side delivery. So it's part of this swing low, part of an expected redelivery between the high of the daily buy side and balance, sell side inefficiency, which is this level up here, and the low of that same daily buy side and balance, sell side inefficiency. Okay, so if we are up in the upper portion of that range, because here's the consequent encroachment between this level and this level, and we're seeing the market start to break down like it's doing here, this inversion fair value gap, this is part of what many of you ask, how do you know which fair value gap is going to be an inversion fair value gap? How do you know which fair value gap to use? I'm employing a lot of different things. Time and price. I'm using institutional market structure, not your classic higher high, lower low crap, because that's infancy. It's too myopic. You need to know what you're looking for. In the grand scheme of things, price was already working its way down into and towards this redelivery on the buy side and balance, sell side efficiency low. That's this price level down here. So if we are looking at this price leg running higher with the expectation that we're going to see it roll over, this becoming a fulcrum point, high to low, projected down, that gives us a reasonable expectation to see it reach into a discount range, which would be half of the range between this high and that low, which makes the daily buy side and balance, sell side efficiency. If you're first time watching this, I already said enough to completely confuse you. But I promise you, if you take a few times to watch this video, the only thing I'm stating is all of this price run here going down is just simply trying to get down to this level here because it was one singular candle on the daily chart that went up. So that market will efficiently deliver sell side delivery, which is not sell side liquidity. Sell side delivery is just the market goes lower. It books price on the downside. In other words, it's offering price between the range high of the daily buy side and balance, sell side efficiency at 15,361.5 and the low of that daily candle buy side and balance, sell side efficiency at 15,126.5. So the only thing I'm stating here is if we were to take that range, which is the daily candle, and I'll explain again what I'm showing you here on the daily chart. But for now, conceptually, just imagine if half of the range from that price level here and that price level here, half of that range is here. Anything at that price level or higher is a premium. If we're bearish, we really want to be selling short up here with the expectation that it's going to aim for something down in the lower half and ultimately perfectly delivered to this lower level, 15,126.5. It need not do that. So what levels are we looking for? Because we're not dealing with zones. Well, what's the lower quadrant? Lower quadrant price level is here, 15,185.25. Half of the range on the buy side and balance, sell side efficiency on the daily chart, which is this high and that low that's in purple, half of it's here. Half of the half point and the low is the lower quadrant point. So that's why I was saying on Thursday to have these levels noted, and then you have the Tuesday, August 29th, 2023, 10 a.m., 1 hour, buy side and balance, sell side efficiency low. And I already mentioned that before we drop down the lower time frames. So everything I'm saying here, I've literally pointed to and referred to what it is in this very video. So you don't have to go anywhere else searching for anything. It's just a matter of listening to what I'm saying here and then finding it in the chart and also following along in the narrative as why I'm interested in this very fair value gap at all. Because we're in a premium. I'm expected to see this price leg roll over. It already broke below it here. So it rolls through. I'm not interested in selling short there because I know that time is a bigger factor. So when price is running up like this, I'm not trying to chase that. I'm not trying to be an early participant. I want to see price get to 8 o'clock. 8 o'clock is here. So the market trades back down through it again. We're not supply and demand. So every time you see a little rectangle here, the neophyte, the first time viewer, or someone just has a superiority complex, they'll say that I'm teaching supply and demand. It's absolutely not, because I'm looking through all of this to go right back to that specific candle right there and its specific price levels. It trades up to it here. Now, because of time, I'm expecting it to have a better influence over price. Does it send price lower? Yes. One more time it comes back up and hits it again. Does it go through it again? No. It's stopping because it's referring right back to that price point right there. So if this is a fair value gap and I was bullish I'd be interested in buying it when it was going down into a here. Or if it went down through it and it came back above it, now I treat it as, a reclaimed discount array. I'm looking through these candlesticks to a specific PD array, but I'm applying narrative, which is a very hard thing to teach because it's learned conceptually by experience, seeing over and over and over again. That's why I'm trying to tell you that what some of you are asking for is a one-shot, one-kill video where it literally answers all your questions in one visit, one sitting, one view, and it's it. Nothing is like that. Okay, but this approach to using an inversion fair value gap, because otherwise it would be bullish here, it's not, because we're in a premium. I want to be short. I want to be looking for shorts because I expect that daily chart, that big bullish green candle, is going to be redelivered to the downside. And the first level I'm looking for is the halfway point and the quadrant, the lower 25%, which is here. And then dug into the hourly chart, buy side imbalance, sell side inefficiency, which is what I mentioned earlier before we got into this part of this video. That's where those two levels came from when I quoted on Twitter before we got down to it. The way that this inversion fair value gap is being implemented is my model, my Deuce. My Deuce is a slang or nickname used for the M2 machine gun. Okay, so that's just the way my mind works. And the way I kind of like classify things, I have 81 different PD arrays. And there's several things that I can do with each one of those PD arrays. This is simply an inversion fair value gap. How I use that fair value gap is a model. And if we have a inefficiency, as outlined here, between the daily buy side imbalance, sell side inefficiency high and low, we're bearish, we're looking for lower prices. We get this market structure in agreement, and then time of price, we're expecting an 8:30 delivery. We can get in here and use this and get ahead of, yes, get ahead of and enter before the news. It's like an x-ray view, tips your hand, or tips its hand to you and tells you this is what it's likely to do. And you have the inefficiency here, it trades up into it, and at the delivery of 8:30 news, and then we see it run away on the employment numbers, trading down into the lower 25% quadrant between this low and this high. The lower quarter or quadrant level is here, trades to here, and then trades to the 15,175 level, and then ultimately we've seen it go higher from there. I'm going to zoom in a little bit. There's that gap. So that inversion fair value gap, within the context of expecting it to trade lower, best case scenario, being the low of the daily buy side imbalance, sell side inefficiency for NASDAQ, but needing it not to do that to find profitability, which is first partial would be here at consequent encroachment, and you let it run some more to get down to the lower quadrant. And that level, you want to take a partial, and then if you can get down to another discount array, which was in close proximity, which is only 10 handles away, which was that hourly buy side imbalance, sell side inefficiencies low on this date and time on your hourly chart. So that's why it's annotated that way. You can go back and look at it when you're in charts. I want to take you back up again. Just know that this is what I'm showing you here. This range, how I'm employing the inversion fair value gap there here for my Deuce. My Deuce is a model that you can use a inversion fair value gap when you are expecting price to run right back down a inefficiency that was buy side imbalance, sell side inefficiency. This can be reversed when you have a sell side imbalance, buy side inefficiency, and you're expecting price to go higher. The inversion fair value gap here would be something after a low, and it would trade back down to it and then send it higher. So everything here is just completely reversed. And I know if you're brand new to my stuff, I'm quite certain you're probably confused right now, and you just have to study it. But really what I'm saying here is this level here and this level here on the hourly chart is this one singular candle. And what I'm saying is on Thursday, I was anticipating the run down into at least the lower quadrant, the lower 25% between this and this. which are these levels here respectively. This candle's low, this candle's high. So we have one singular pass higher. We expect lower prices to be delivered the same way, just going back down to redeliver over the inefficiency here. It was buy-side delivery, but now it needs sell-side delivery because it's inefficient in that regard. Because there's no other candle between this candle's low and that candle's high. Only one candle went higher. And that range defined by that candle here, this low and that high, needs to have efficient delivery. That can only happen by having price go back down inside this entire range. Lower quadrant, halfway point. If you have a inversion fair value gap and you're bearish and you're expecting a news report and it's tipped its hand to you saying, okay, we are likely to break lower in market structure and lower time frames, we can anticipate this drop. That's occurring in here. Drop. And that's occurring in here. Drop. And zoomed in inside that premium to discount. That's the inversion fair value gap. My Deuce, second opportunity to get into it again. It breaks aggressively. Inefficiency once more at 8:30. Employment numbers runs aggressively. Partial here. Partial. Best case scenario would be if it would deliver to the low of the hourly. But I mentioned real time. I said take your profits. Don't be greedy. And then we've seen it go a little bit lower than my objective on that particular day, but never got to the low of the daily buy side and sell side efficiency, being this level here. It never got to that level. So I'm certain it's a lot for you to digest, but every one of my PD arrays, you can apply it to specific elements of market structure and how you anticipate price delivering, and you can plug and play each one of these PD arrays with the expectation that the model will deliver under a specific premise. We're expecting this level here to this level here be delivered with downside delivery and or sell side delivery as price was going lower. It's not random. It's not going to some random level. It's going to very specific price levels. And if I'm going to use this inversion fair value gap, I can use it in the context of my Deuce. My Deuce is simply a model utilizing an inversion fair value gap. So that PD array, it's an advanced version or application of inversion fair value gap, but it takes you right back to the core context of where are you in price, what's it likely to go to next, and are you in a short-term premium or short-term discount? If we're bearish and we're in premium, we can anticipate price reaching down into a discount, but not some random level, very specific levels. And it need not go to the best case scenario, which would be the low, which I still hold true that I suspect at some point, maybe next week, that we'll try to reach down here until I'm proven wrong. And I'm okay with being proven wrong. I'm not going to be trading it. But the idea is I expect it to trade down here because the E-mini S&P has already traded it to its respective buy side and balance sell side efficiency for its daily chart. All right, folks, that's it for this one. Enjoy your weekend. Thanks for watching. Until I talk to you next time, be safe.